if we start with demand, demand really wasn't the problem. The world grew at its fastest pace in 5 years, and that was really led by two areas, Chinese demand and US demand. Chinese demand was very strong, contrary to sort of popular belief. Chinese demand was strong. It was led by the consumer, anything to do with the consumer like LPG, propane, kerosene, gasoline was up double digits, 20%. US demand was strong as well. They saw the fastest growth in gasoline in 30 years, partly due to the fact, the high elasticity of oil price and demand, and the fact that MPG was down, miles per gallon was down. So it was a combination of less efficient cars and a low oil price that drove that consumer to drive. The IEA actually anticipate that the next 5 years will be higher growth than the last 10 years. Really, supply was the issue. 83% of supply growth came from Iraq, Saudi, and the US. The US continued to grow quite quickly at a pace of about 1.1 million barrels a day, due to the fact that they had pre-commitments to drilling equipment, and also there was a mid-year rally to about $70, $75 on the futures. So normally we'd expect Saudi to come in and rebalance the market, but they switched policy in November 2014 from being a swing producer to actually protecting market share. Consequently, we saw an oversupply of about 1.7 million barrels a day, and inventories grew to about 3 billion barrels. We expect supply to start coming off mid part of this year and rebalance the markets next year. The outlook for supply is we believe it will contract by midway through this year. Non-OPEC supply is contracting quite significantly, a little bit faster than the IEA expect. In fact, countries like China have cut supply predictions by about 10%. They are the fifth largest producer in the world, thanks to their struggle with mature fields and the fact that they're just simply not making economic sense at $40, $50. But it's the US that will probably lead the decline, thanks to their reliance on short cycle oil. The API, the American Petroleum Institute, believe that there will be a 90% drop in new wells being drilled in the first quarter of this year. We have seen the fastest and most extensive rig decline in history. It has fallen to levels not seen for 20 years. Consequently, we believe that US production will fall by about 750,000 barrels a day by the end of this year. That will take it from peak to trough to a contraction of about 1.2 million barrels. So this will help tighten markets going into 2017 and rebalance during the first half of 17. Short cycle oil is actually quite a new phenomenon, and it's really it describes what is happening in the US. From the time that projects get approved to the time they're actually drilling can only take between about 4 to 6 months. And you actually lose about 85% to 90% of your production within the first 2 years. Now contrast that to what was happening in the 1980s, when we saw our last big supply contraction, or our supply-led market contraction. Projects such as Prudhoe Bay in Alaska, Mexico, North Sea, and projects in the North Sea were all long cycle projects. They took maybe 7 years to actually come to produce their first barrel. And then so much cost was sunk, billions were sunk, that actually production was just held at the same level despite the move in oil prices. Consequently, we saw a very slow reacting oil price back in the 80s, as opposed to now where we see a very quick, fast reacting supply cycle. Over the next 5 years, we expect demand to increase by between 1.2 and 1.5 million barrels a day. We expect depletion rates from existing fields to be around 2.5 to 4 million barrels a day. Essentially, we need new production to equate to around 4 to 5 million barrels a day every year. With short cycle oil only providing the world currently with 5 million barrels a day, or 5% of world production, we're okay to see new supply coming on in the short term from that source. However, further out, in order to rebalance the market or meet ongoing supply shortages, we will need to see long cycle oil coming on now. Long cycle oil takes around 3 to 4 years to come to production. Consequently, we need prices to turn to levels that justify long cycle oil, which is around $65 to $75 a barrel right now. With a focus on managing the cyclicality, the fund has performed well, outperforming the benchmark over 1, 2 and 3 years, attaining a number 2 ranking since inception, a number 3 ranking over 1 year, and a top 10 finish over 2 years. So a consistent top 10 ranking out of around 200 funds since inception. And because the cycle is so important to us, it's important to point out that we have outperformed the benchmark when oil price initially moved higher, then when it collapsed, and since it has subsequently recovered. When we set up the fund, what we wanted to do was really analyze the anatomy of the oil sector. So if we look closer to the source, we can see that oil price sensitivity is high. So companies, the seismic companies, oil producers, the drillers, they're all pretty highly oil price sensitive. As you move further down away from the source and closer to market, oil price sensitivity is lower. So in tankers, refiners, integrated oil companies, oil price sensitivity is lower. So subsequently, if we believe that oil prices are moving higher, we want to adopt higher oil price sensitivity, and we skew the portfolio towards the higher oil price sensitive areas and closer to the source of the oil. If we believe that oil markets are moving lower, we skew the fund towards lower oil price sensitive areas and closer to the market, so the tankers, refiners, integrators. Consequently, this has meant that we can, and we believe that we can outperform both as oil prices fall and oil prices rise. Non-OECD demand growth is just overtaken OECD demand growth. Consequently, the growing part of the demand curve is entering into its dominant phase. We are seeing about 94% of future oil demand being driven from non-OECD regions. A second driver are environmental pressures. We believe there's an urgent need to move away from coal and towards gas and renewables. This shift away from coal is being enabled by a build-up of supply in gas from the US, such as methane, propane, and ethane. Consequently, much of the gas is being produced west of the Suez, and much of the demand is occurring east of the Suez, setting up the need for significant spend on logistics chains. The third driver is engineering intensity. The fact that we are using or emptying the equivalent of an Olympic swimming pool of oil every 14 seconds, and demand keeps on growing, we require significant investment to find new sources of oil. That means offshore drilling, having to move deeper, and we're having to move to technologies such as fracking and opening up rocks to unlock carbon resources. This was unheard of 10 years ago. And again, this is going to require significant continued investment. The fourth driver is cyclical management. The fact that Saudi are actually moving and shifting their role from being swing producer to one that is protecting market share means that we are going to see higher volatility in the oil price. And that is why we feel that allocating your highly cyclical exposure, such as energy, to a manager that focuses on the management of the cycle is an approach that can help investors generate alpha.